All right, thank you, Michael. I want to remind you that you can type your questions into the chat box, and I will be reading them for Michael. And also, Michael's already mentioned it, but our next seminar is in 2 weeks' time on the 25th of November. I think that the registrations are going well, but if you look at your newsletter, you'll see the link to register for the seminar. Also, don't forget about the mega recruitment drive. Now, I don't see any questions in the chat box, so I'm not sure whether it's, oh, here's one. If COVID is being financed by governments, how does this play out when it's time to pay back?
Yeah, well, good question. The answer eventually is going to be you and me, because we're the taxpayers, and at some point the bills are going to have to be paid. Although it's interesting that, you know, after World War II, when huge amounts of money was borrowed, the government's approach was simply don't pay it back. And essentially what they hope will happen is that they will inflate their way out of the problem, which means that as the economy starts to increase, they'll just keep pushing and pushing and pushing the economic levers to try to get growth at almost any cost. And with the idea that essentially a dollar today is only going to be worth 50 cents in the future when they do have to come to pay the bills.
Yes, that doesn't bode too well for future generations, which is even more important for us to make sure that our portfolios are well managed. Again, I remind you to type your questions in the chat box. We've been having some problems with the webinar this morning, so I want to apologize for that. For a while there, my screen was frozen, and some of you couldn't see the poll questions. So hopefully those problems have been resolved now, and we can see if there are more questions. I don't see one right now. So Michael, I'll have one for you.
Do you have a hat to match?
I forgot to bring my hat this morning because I'm in a different location this morning. Normally I'm in my office at home, but I'm in a different office this morning, and I forgot to bring my hat. But I congratulate you on your hat. It's a very nice one. And I actually got a Panama hat when I went through the Panama Canal a few years ago. But what happened is I lost it on one of the, on another trip. I left it somewhere and I never found it again. We have a couple of questions that came in here, so we'll deal with them. The question is, what do you think about building a bond ladder of strip bonds with a range of maturity dates that roughly match with the amounts that you must withdraw from your RIF?
Well, I think overall it's a strategy that makes sense. It depends, I guess, to a certain extent on how sophisticated you are in being able to handle that. One of the problems is that buying individual bonds is a real pain because the price of them is not in an open market situation like stocks. And so when you buy it from a broker, they basically set the price and you pay whatever it is they charge. So it's hard to know if you're getting a good deal or not. But certainly, you know, taking a laddered approach is a good idea. There are some ETFs that do that for you. So for example, Royal Bank has a corporate bond ETF that has a 5-year laddered bond portfolio. And so they essentially do that for you. And that may be an easier way to do it. Similarly, you can use a preferred share ETF that BMO has that does a 5-year ladder of rate reset ETFs. So I personally don't own individual bonds just because I find that they're very complex to deal with, and I'd rather let somebody else do the work.
Right. I see that someone here is asking if the slides will be available as a download. Just to remind you, as I mentioned at the start, after the presentation today, you will receive an email to give you information on where to access the slides on our association website, as well as information about the mega recruitment drive. So don't forget to look at that as well. Next question is China included in ETFs as a developed or undeveloped? I think it's an emerging country.
Yeah, China is still classed as an emerging market. Although if anybody who's been to China knows, and I've been to China many times, seems to me China emerged quite a while ago. And in fact, I would argue that we're probably into a period where China is about to be recognized as the leading power in the world. And but still to today, it is counted as an emerging market in almost all ETFs and funds.
Okay. Next question is with respect to REIT, R-E-I-T. Instead of investing into a REIT ETF, why not, depending on your own house, as an investment? I think looking at the increase in value in the housing market, which has been substantial this year in Ottawa and other places as well. So why not consider that as an investment rather than some other ETFs dealing with property?
Well, generally, people who invest in REITs are doing so instead of buying investment property. So it's we all have our own houses, and it's a good point that we should take into account in looking at our overall portfolio, what our own principal house is worth. On the other hand, you need a place to live. So while it's partly true it's an investment, it's also true that it's a necessity. And as I say, a lot of people buy income property for that extra income to help pay for their retirement. And I know a lot of people have had really bad experiences with income property. And particularly today, as you may have read, there's a horrible problem with people simply saying, I'm not paying rent. And there's nothing you can do about it because there's a moratorium on evictions. So you're sitting there possibly with a property and earning nothing from it. Also, a lot of people have found that there are expensive repairs that have to be done, tenants that disappear in the middle of the night, tenants who, of course, don't have pets and then bring in some massive dog. So for people like me who frankly hate owning property, REITs are the nice way around it because somebody else professionally manages it all. And actually, it's interesting that if you, other than up till March when the REITs really took a kicking, up till that point, if you look back about 10 years, the REIT performance was about equal to the performance of individual housing. So you got the same benefit with basically none of the work. And I really like the none of the work part.
Yeah, I like one of the quotes that you used in another seminar, Michael. A REIT is a way to own property without having to fix the toilet.
Exactly.
Yes. Next question here is, I don't see it coming up on the screen yet. So I had a question for you, or maybe it's more in the form of a comment. I've been looking at my own portfolio recently and making some changes. But what I was seeing is wild changes from week to week, almost from day to day. How can we best protect ourselves against these wide variations?
Yeah, and you're right. It's been really pretty wild. Give you an example. I was looking at Shopify stock the other day. Shopify hit a high of around 1,500 Canadian dollars. It went down as low as, I think, under 1,100. It's bouncing around. I'm not even sure where it is today, but since roughly I guess, May or June, it's down 20-25%. And what happened is when that announcement came that Pfizer may have found a vaccine, the sort of old-fashioned stock market rallied, and the new stocks, the Amazons, the Shopifys, the Zooms, all got KO'd. I think Zoom was down 17% in one day. So to answer your question, the answer is diversification. You set up a nice, well-diversified portfolio using something like these all-in-one ETFs like VBAL, and then frankly, you don't worry about it. Let them take care of things, because if the stock market drops, the bonds usually will go up, and the gold will usually go up. So if you've got that well-diversified portfolio, you're not going to make a killing, but you probably will be able to sleep at night.
Another question. Some of us, and I'm among that group, are nearing the time where we will have to convert our RRSP into a RIF. So what would be a good strategy when we look at moving our portfolios to a RIF in terms of protecting it? You've talked about that a little bit in the presentation, but in terms of protection to make sure that the yearly minimum withdrawals are covered at least in part.
Well, again, as I mentioned in the presentation, we're at a particularly interesting time where you can get quite high returns from things like these REITs or preferred shares or Canadian dividend shares. I mean, to be able to buy a dividend ETF that's yielding 5.5% is not usual. So by putting at least some of your money into these sorts of things, as I showed in that model portfolio, you can get at least close to that 5.2%, which is the minimum withdrawal at age 72. So, you know, one of my earlier webinars was titled, "There's Always a Bull Market Somewhere." And right now, it seems to me that the opportunity, or an opportunity, is in these sorts of things that are paying these very high distributions. So I'm in the same boat. You know, it's going to be having to switch over to a REF next year, and that's what I'm going to do.
Okay. Someone is asking if you could create a document with all of the acronyms in the presentation and post it on the association website. So Michael, I'll leave that one with you.
Yeah, I try to avoid using too many acronyms, but you know, you get used to this stuff, and you forget that some of the acronyms are not that familiar to people.
Yes. A lot of the questions came in now. When governments are heavy in debt, does the investment strategy change versus when it's high consumer debt? And don't we have both right now?
Well, debt is through the roof, that's for sure. But, you know, surprisingly, at the same time, the world is awash in cash with no place for it to go. So it's a really strange time. And I'm not sure I know what the answer is, but I can tell you this, that at the moment, there is something like $15 trillion worth of government debt, which is trading at negative interest. Negative. There's so much money around that people are willing to buy government bonds that actually cost them money just so that they have a place to put their money. So it's awfully hard to figure out, you know, what's going to happen with all these debt loads. But again, that's why you need to have a very diversified portfolio. And that's why you need to have some circuit breakers in it, like bonds, like gold, so that if and when things really do get bad, you've got something that may still do better. but it's who, I guess we're at the point of saying, who the heck knows?
And of course, things change as the political situation changes, not only in Canada and the States, but around the world.
Yeah.
Which brings me to the next question. Do the North American stock markets include international stock index ETFs?
No. The North American stock market, basically it's Canada and the US. And it's mostly the US. People have to remember that the Canadian stock market is approximately 3% of the world. The US stock market is much bigger, around 20%. But when we talk about North American, it's basically just Canada and mainly US.
Okay, our next question, I'm not sure that I understand it here, but I'll read it. What do you think of unit trusts XXX.UN example as an investment?
I'm afraid I'm not familiar with it, so I can't comment. Do you know that?
That's one that I'm not sure what the question is here that is being asked.
I haven't come across it, so I'm just not familiar.
Okay. Do you have, next one is, do you have any thought regarding the new Vanguard VRIF? I think you mentioned that one. You talked about that one in the presentation.
Yeah. Well, I think it's an interesting design. I mean, it's basically designed to pay 4% no matter what happens, whether markets go up or down. And they're going to manage it so that they pay out the 4% per year. So, and they named it VRIF, basically to attract people who need that income in a RIF to meet those mandatory withdrawals. We'll have to see how it works, but you know, Vanguard is a very good company. They've got something like $5 trillion under management. They're the second biggest in the world. And by the way, interestingly, Vanguard is about the only one in the business who is a nonprofit. It's actually owned by the people who own the investments. So it's got a very good history, a very, what shall I say, moral company, and hopefully they'll make it work.
And they've been doing fairly well lately. Full disclosure, I have some Vanguard ETFs in my portfolio, and that's one that I've been satisfied with, but that's not a recommendation to anyone. You have, as I said, you have to do your due diligence. Someone is asking, is VRIF in your RIF portfolio slide? I think that one, Michael, when you were talking about the VRIF in the slide, it actually said VBAL. So maybe that's something that we could look at before posting it on the website.
And it depended on which portfolio, but the one for the RIF, I certainly meant to use VRIF in it.
Yeah. Yes. Next question is unit. Oh, that's a question that we had before about the XXX.UN. Unit trusts are like ETFs, and ones like UTE.UN, BTB.UN, and BSO.UN are paying 7 to 20%. I'm not sure there's a question there, or if it's more clarification about the previous question.
Okay. Well, I think what they're referring to there are things like split share units. Look, the answer could be quite simple. If something's paying 7 to 20% in an era where interest rates are 0.5%, then you have to ask why. And the answer is almost always a lot of risk, that they're doing financial engineering. Let me tell you a little story. I had an acquaintance who mentioned to me at one time that he had found this great investment that was one of these split share corporations that I think used the .UN type symbol. And he said, look, this thing's great. It's paying 10%. And I said to him, well, you know, if something's paying 10%, you got to take a very hard look at it because they're using leverage and other financial engineering. And when things are going up, they do great. But when things go down, they do much worse. Anyway, I noticed that during the recent turmoil, that investment went from about $8.65 a unit to $4 in a period of about 30 days. So these things all sound great, but you really have to understand how they work. And it goes back to what I said at the beginning, there's no reward without risk, and the more reward, the more risk. And that's just the way the world works.
Yeah, that's one of the basic principles, more reward, more risk. That's something that I drove home to students when I was teaching, certainly. I see that we're getting to the end of our questions here, so I would like to, and a number of people, as a matter of fact, have joined me in thanking Michael for the presentation. That was, as usual, an excellent presentation, very informative. And Michael, I know that you put a lot of work in preparing and updating, keeping these presentations current. So on behalf of all of our members and as well as the board of directors for the association, I want to underline that and thank you for it. I also want to remind you that you will be getting an email with the information to access the slide. And thank the people that work behind the scene to make these presentations possible. Today we have Sarah Campbell, who was our Zoom guru. We also have Frank Schindler, who couldn't join us today, but has been instrumental in making these webinar possible. So once again, thank you very much, Michael. For those of you who are interested and haven't registered yet for the November 25 seminar, webinar, look at your newsletter. You'll get information on how to register. You'll get the actual link. And everyone, please stay safe and take good care.
Okay, thanks again, Alain.